everyone, welcome back to my channel. My name is Reni. If you're new here, welcome, or if you're a returning subscriber, welcome back. On my channel, I do fashion, finance, and lifestyle content. So today's is around finance and real estate, and we're going to talk about mortgages. If you are new here and you haven't yet subscribed, please hit that subscribe button. And whether you are new or returning, please hit that like button as it really helps me with the algorithm. So today's video, as I said, is going to be all about mortgages and the process of getting a mortgage and what a mortgage actually is. I know that this is one of the biggest purchases that anybody will make in their entire life, so I think it's important to go into the process very informed and know what type of mortgages are available to you. So today I'll just tell you what a mortgage actually is and then go through the different types of mortgages that there are. Before I even start, I want to ask you a question so we can get those comments moving. What is your knowledge of mortgages on a scale of 1 to 5? How much would you say that you currently know about mortgages? 1 being not anything at all, 5 being I'm an expert, but I just decided to watch this video just because. So let me know in the comment section below. Okay, so let's begin with what is a mortgage. In many other countries outside of Canada, mortgages aren't really an option. The interest rate is ridiculous, or it's just not a norm there. You pay everything with cash. In Canada, on the other hand, we get a mortgage to buy our homes, and we use credit for a lot of things in Canada. And what a mortgage essentially is a loan that you use in order to purchase a property. So say that the home that you want to buy is $300,000. Most people that I know at least don't have $300,000 just laying around that they want to use to purchase a house. And even if they do have that money laying around, they're probably not going to use it to purchase a house. So what they do is that they get a loan for the remainder of the house that they cannot afford with cash. For example, with that $300,000 house, if I'm going to put down 20% is about $60,000, and then I will get a mortgage for the remaining $240,000. So this means that my money plus the bank's money will be given to the seller, and then it will pay for the house. The reason that the lender does this is because they're gonna charge you interest on that money. So you loan $240,000, but you're not just paying the lender back $240,000, you're gonna pay them $240,000 plus interest over a set period of time. To get your mortgage, there are a few options that you can go through. You can go through a mortgage broker, you can go through a bank. I have an entire video about this comparing the two. And there are other options like private lenders, but for the most part, we're just gonna focus on mortgage brokers and the banks. In Canada, there are 2 major categories that mortgages fall into when it comes to their term. That would be either open or closed. Let's start with closed. Most mortgages in Canada are closed. This means that you cannot pay out the mortgage in full before the period of time that you have specified without paying a penalty to the lender. So say I was approved and I got that $240,000 mortgage in order to pay for my $300,000 house. Then let's say the next year or 5 years down the line or whatever it is, I'm like, oh, I won $500,000 in the lottery. I cannot just be like, okay, I'm gonna put $240,000 and pay off the rest of my house. Well, I guess you could do that, but you would pay penalties because it is a closed mortgage. With most closed mortgages, however, they will allow you to pay a lump sum every year, so a little bit more than the value than your monthly interest payments. However, you cannot just put down and pay off your whole mortgage before the specified time that you have determined earlier. From your point of view, you might just be like, why won't the lender just accept my money without penalty? Like, they're getting their money up front, why do they care? But the reason that they care is because the bank is a business, as I said, or the lender is a business. They have loaned out your money, so they have loaned you $240,000 at, say, a 1% interest rate. But then they have also, they're borrowing people's money at 0.05% interest rate. So they banked on you paying that 1% interest rate to them on your $240,000 for the next however many years. So they have done their financials and they're like, okay, I have enough money to cover the money that I owe and also make money and also make a profit because I'm lending these people money out at a higher rate. So basically you're messing up their business plan when you want to pay off your mortgage early. So they're like, nah, we're not going to take your money unless you're going to pay penalties, which can then help them figure out their financials as well. Closed mortgages are offered in terms of 1 to 10 years, but the most common by far term is 5 years. Now let's go on to open mortgages. With an open mortgage, they allow you to pay off the mortgage at any time without penalty. With an open mortgage, however, you will pay a higher interest rate than if it was a closed mortgage. They also do have a higher administration fee, so when you do close or pay off your mortgage, there'll be a higher administration fee that you have to pay. This really emphasizes why it's so important to look at the details and the fine print when you're determining it. You need to see what the actual charges are that they're going to charge you when they close. It's not just the monthly mortgage payments, as I said. If you decide to pay early, what are the penalties that impact this? And if you reach out to a mortgage broker, they can also help you find the mortgage product that works best for you across a variety of lenders. For most people, in the majority of cases, it makes more sense to get a closed mortgage, and especially if you do not intend to pay out your mortgage in a shorter period of time. Open mortgages are typically offered for 6 months to a year, but they are rarely ever used to purchase someone's principal residence, the residence that you are going to live in. Open mortgages are really used when your funds are tied up in another property or somewhere else, but they will be available once that term ends. So once that 6 months ends or that 1 year ends. So now that you've heard these two, let me know, would you rather do an open mortgage or a closed mortgage? Let me know in the comment section. Next, let's talk about the interest rate, the magical interest rate that we all hear about. So in both types of mortgages, you have the option to do either a variable rate mortgage or a fixed rate mortgage. Personally, I chose to do a variable rate mortgage, but it is a very personal decision. Contact your mortgage broker and then they will help you determine which one is best for your situation. So let me go through the difference between the two right now. A variable rate mortgage has a rate that floats with the prime lending rate at the time. As the economy changes and different changes in the economy happen, which impacts the prime lending rate, your mortgage rate will also change. So say you started your mortgage at a 1% interest rate, and then interest rates crash, your interest rate could go down to 0.75, but it could also go up to 1.5%. There's really no stability with this rate. It goes up and down as the economic conditions change, and this is most common for closed mortgages. As I said, I decided to go with this rate simply because I wanted to be able to cash in on the low interest rates that we're seeing right now. And the thing is, you can also lock in the rate. So I can get a variable rate, but if I see the interest rates are starting to climb up, I can say, okay, I'm going to lock in the current rate and get a fixed mortgage for the rest of my term. Another option is your fixed interest rate, and as you can tell, the interest rate will be fixed for the duration of the term. So this means that your payments every month are going to be set for the 5 years or however long your term is. They will be the exact same rate. This makes it very easy to budget, of course. So let me know, which one do you prefer? Do you think it's better to get a variable rate or a fixed rate? With an open mortgage, this is ideal if you have a short-term need and want the flexibility of being able to pay off the mortgage at any time. Note that this does come with a higher interest rate. With a closed mortgage, this is the most popular option and is ideal if you do not plan on prepaying your mortgage. There are strict guidelines to abide by with this mortgage, such as dictating the amount that you can pay each year and the amount that you can prepay, so it's important to follow them if you want to avoid penalties. With a variable rate mortgage, the benefit is that the rate can go down if the prime rate moves down. But the con is the same thing. The rate can move up if the prime rate moves up. So there's less certainty with this as your payments really aren't set. And then with the fixed rate mortgage, the benefit is that regardless of whether rates rise or fall, your interest rate will stay the same. This makes it easy to budget. A con is that the fixed rate is typically higher than the variable rate, so you have to determine if this is the premium that you are willing to pay for stability. For whichever mortgage you choose to go with, I think the most important part is that you choose an expert that knows what they are doing and they can guide you properly and that will really ask you questions and see what is best for your situation. If you're planning on flipping a house, maybe they will suggest this type of mortgage and this type of lender, and if you're planning on living there for the next 10 years, maybe they'll suggest this type of mortgage. It's all dependent on your individual situation. And I think it's great to get referrals for professionals, so I'm going to refer an expert to you today. Doug is a mortgage agent at Dominion Lending Center's Pareto Mortgage Group here in Ontario, and he is here to help you find the dream property for you. He's going to work with you to understand your situation, figure out your unique needs, and find the mortgage product that is best for you. I hope that you will all reach out to him, and I will leave his links in the description box below. If you're not ready to speak to a professional yet, no big deal. I'm gonna refer you to an app that you can use to determine how much house you can actually afford and then see the different mortgage products that are available for you. Once you do see these numbers, maybe you'll be willing to talk to a professional. And I will leave that link in the description box below as well. And if you do fund your mortgage with our partner for today, Dominion Lending Centers, you will get up to $250 in gift cards when you do secure your mortgage with them. And there will also be a donation to a Canadian charity of your choice. So it is a great deal. It supports my channel if you do download the app or if you do work with Doug to fund your mortgage. So I hope that you will do so. If you have any questions for me or for Doug, please leave them in the comment section below. I always want to hear from you. And remember, I want to make videos that you want to see. So let me know what you want to see next and I will get those videos done for you. Thank you so much for watching. Have a great day, everyone. Bye.